Good morning, folks, and welcome to this morning's video. So I have one pair on watch today, which is Euro Yen. The market looks like it needs a bit more development across the board. Just to say that I placed a trade on Monday, I believe it was, on Pound Yen. I did try and recap that for you guys yesterday. I didn't make a video the previous few days because it's been a bit of a crazy week here for me personally, but I did try and make one yesterday. But as I was trying to save it with that trade recap involved, TradingView went just a bit nuts and started doing crazy things, and then it lost my video and just went back to this chart that you see before you. So we shall try again. So I'm going to recap the Pound Yen position and then talk about what I'll be looking for on Euro Yen. What I'll be looking for from Euro Yen, again, may not be ready by the end of the day. It likely won't, but again, just like the story of the tortoise and the hare, we don't excuse me, we don't fall asleep on the job. We stay sharp just in case things shape up a little sooner than we were anticipating, just in case that tortoise catches up, so to speak. Okay, we need to stay sharp at all times. Just we never know what's going to happen. So Pound Yen, I was looking at this position because yes, we had these gaps up here. So we had this near miss to here, and we had a correction beneath this impulse, which was much wider than the impulse down was long. Okay, so in the long term, we could be gravitating back up to these areas to give us what we call an M-style pattern. An M-style pattern being when too much volume accumulates relative to the impulse down, and we end up tagging the top again and then moving down from there. However, that doesn't mean to say that that happens or will happen straight away, even if it even if it doesn't happen, even if it does happen at all. Okay, we could still be capitalizing on a move down to these lows here, because you can see we have a gap to that low, and on the slightly lower time frames, you'll see a gap here to a gap to this low, where there was an exchange of liquidity, which was the footprint after price broke out of all of this volume. So there's also an area that's an area of significance, okay, when that happens. So you can also see that we have the 1, 2, we have the gap to that high. When we see a gap to the high, that implies that there's likely liquidity there. When people start selling here, they often have their stops just above the high that's just above it. Okay, so that likely means that if we gravitate back towards that area, there's likely stops above there. We tap the stops, as you can see there, and then we move to the downside, and then we move down in the form of 3 progressive candles. So this is not one big candle which can retrace quickly, which is often what happens when you get just one big candle. A lot of the time they can retrace very quickly, or retrace 50% of the move very quickly. We've had a progressive, impulsive move down, okay? So that implies stable, impulsive price action. So that means that we could therefore be looking for further continuation, just looking for the sideways correction, followed by a way to get in for a further move to the downside, to ride the wave, as it were. If we just look at the previous weekly candle as well, we had that previous weekly candle. So we've had the wick above, the washout, push down. We've had a daily confirmation, which confirms the thesis. So now I'm on the 4-hour chart looking for entries. Okay, so we've got the consolidation. We have an impulse, correction, continuation, a further consolidation. And then if we just drill down a little bit further, let's just unpack the trade a minute. So we have, so I'm separating the structures a little bit. So we have the impulse correction move down. We have this correction, price taps above, taps out all the stops that were likely above that high, pushes to the downside. We have this little run-in channel, price moves to the downside. We leave a bit of a footprint here. Okay, notice this high here, it retests the back end of that, so that doesn't necessarily mean to be relevant. We have this high here. I am aware of that. However, I'm also aware that that kind of scoot back up to tap that, and I think, if I'm not mistaken, it also retests the back end of that as well. So that's not necessarily relevant, although I am aware of this high sat above. But what I'm also factoring in is that we have a bit of a near miss to here, and this one in particular, near miss to here, suggesting to me that when people were selling here, the stops are likely above here, the ones that I'm interested in. So as we push forward a little bit, just play this forward. So we get the signal price action. So price stalls, it stops in this area, signaling to me that there's liquidity here. Now I'm looking for confirmation. And my rules in this instance were, because it's a 4-hour structure, I can see the lows and I can see these two highs on the 4-hour chart. So therefore, this is a 4-hour structure. So my rules are therefore either a 4-hour rejection candle or two 1-hour rejections. So we got the first 1-hour rejection there. It's not great, but we did get a rejection there. So I'm looking for another one. We get this one. I personally don't include that as a rejection because it closed above the area of value. I'm only interested in candles that close below it, because a rejection is something that rejected an area. If it's closed above the area of value, it's not rejected it yet by definition. So I'm looking for another candle. That one didn't close below. That one did, but it has a huge wick below it. That's not a rejection candle to me. Then we get this one. Okay, so there's a bit of a wick below, but we have a massive wick above and a bit of heavy body as well. So that I was happy with that. I would have had my stop loss a little bit tighter. I always place it below the body of the candle. I would have had it a little bit tighter, but I set the order when price was about here. Okay. And one thing I don't like to do is I don't like to keep moving the order around while price is moving, because one, I think you'll cause yourself a lot of emotions, particularly if you're doing that at scale. But it's also a bit tricky because a lot of the time you can reset it, and while you're resetting it, price has already gone. So, I would have preferred it a bit tighter, but rather than keep messing about with the order, I'm just happy to just leave it. So we got the first rejection, second rejection, and then I was tagged in. This time was 4 o'clock. So then by this point, we would have had a solid 4-hour close. So the 4-hour candle closed like that. So that was good as well. That worked in our favor. And then that happened, wicked out, and then it dropped. Okay. That will happen in my experience. I've got the data to prove this, 5 years worth of data nearly. That will happen the majority of the times in trading. And people, I'm sure there'll be people watching this thinking to themselves, are you not frustrated by that? Does that not annoy you when it happens? Well, it annoyed me the first 100 times it happens, but when you get burned by a cigarette enough times, it doesn't bother you anymore, okay? So it doesn't bother me. I'm sure it bothers some people, but what I've learned about trading is that this will happen the majority of the time. But once you finally know what you're doing, of course, we're all still learning, but once you finally know what you're doing, the wins will offset all of this, okay? So even though this does happen the majority of the time, the wins that you do take will offset this once you know what you're doing. So that was a quick loss for me. I left this overnight and I set a take profit down there to complete this. We just measure the whole range. So measuring this impulse correction continuation, that lined up actually perfectly with that take profit, as it often does, because these things are mathematical even when we draw them crudely. And then if we just play price forward and look what it's doing now. Where are we? What's the date? 23rd. Keep playing that forward. You can see I'm not surprised what price is doing now, because we left we left a gap to that high. So when we spiked above, this left a gap there. So now it's very likely we've got a gap to that high gap. It wouldn't surprise me if this is something much larger, which gives us that, which completes this impulse correction continuation, which just so happens to mathematically line up with the high that we keep near missing to. We shall see. I'm not bothered now because this is not something that I'm focusing on. So that was a loss. So I think that's 5 trades I've placed this month. I think I've had 2 wins, a break even, and 2 losses. So I had a profitable January, February, and March. I lost 0.5% in April, and we're still up for May. So still looking good. And we now move on. I shall move on to Euro Yen. So Euro Yen, what I'm looking for from this pair, if we just zoom out. So the bigger picture, okay, we have the high there. There was an exchange of liquidity here where there was a big runoff last time around. Admittedly, we did come up there, come back up, but that's actually a positive rather than a negative, because look what we did. We came back up, but we near missed to that area, this little spike here. I like it when I can see all of this stuff without even zooming down. We near missed, so if people are selling here, where are they likely to have their orders? They might have them just above here, okay? We gap to that area again. There's likely people who sold here putting their stops just above here. When they did so, gap to that area again, gap to it again. When we gap to it this many times, there's likely a lot of stop orders above there. And sure enough, we plummet to the downside aggressively. If we just analyze the weekly, look at the weekly last week's weekly close as well. Big wick above, ever so slightly above, and the big follow through candle. These are about the best candles you can get for a potential short play. If you see this the week before, or if it's the close on any time frame, but particularly the higher time frames, just before you're about to get short, these are about as good as they get. Ideally you'd want no wick at all below, but that's just splitting hairs. So we get the follow through there, impulse correction continuation. Okay, so, and we can see we also have this little reversal structure there, expanding pattern. These expandings act as reversals when they're met at an area of value. They can act as continuations, but they often act as reversals as well. So we then get the push down. Okay, so I can see here the impulse correction continuations. We left a bit of a gap to that area, but we got to this area. If you look what happened, one of the reasons I'm not bothered about this is because it's above this low. Okay, so once we break below, a lot of the people start putting their stops just above here. This becomes, when it's above a previous low, it becomes no longer relevant, or no longer necessarily relevant, I should say. Okay, and one of the clues that it's not necessarily relevant is we create a new high and we keep gapping to that area, suggesting that this is the new area of value. Okay, and this is actually, the stops are actually in this area. Hence why we keep gapping to it, because every time we gap to it, people are putting their stops in this area. Sure enough, we tap that area and we move to the downside. So what I'm looking for now, and I do like this setup actually, and I like the fact that it's evolved and taken slightly longer than I was necessarily anticipating. So what we have here, so we have once again, if you look at what price did, I showed you that expanding structure on the higher time frames. We have the same thing again, an expanding reversal structure where we've got higher highs and lower lows, which tap the area of value. Then we move to the downside. And what I like about this is that we appear to be forming something like this at this moment in time until the market shows me otherwise. We appear to be forming like that kind of structure, right? Which, if it did form and we got an entry, a rejection here, we would be retesting the back end of all of this volume. So there's a lot of volume here, okay? A lot of orders likely in this area. And look, when we sold here, we left an ever so slight gap to this area. I think here we literally just tapped it, but we've moved down correctively. We're moving down correctively from an area that we just tapped. That's giving me an indication that people are selling this, but the orders that are just above, the stops that are just above, because remember, if people are selling here, they believe that many people believe that this is now resistance, okay? So they put their stops just above, and that would explain why we're moving down correctively, because people are trying to sell this whilst the orders that are still up there are dragging price up, which is why we get these kind of structures. And if we do get something like that, what are we looking for? Okay, is I'll be looking for, just unpack the forecast. So I can see the structure of this as it stands. I can't see the structure of this on the 4-hour chart. If this was to form, I would be able to see the structure on the 1-hour chart. So I would look for a 1-hour entry here. So I'll be looking for price to come down, form a bit of a base, push back up, tap into that area, and then I'll be looking for a 1-hour rejection. I'm just counting the candles. Again, this may not be ready by the end of the day, but it may be, it could be ready sort of 3 o'clock time. We don't know. And if we got that, I'll be looking to get short with a 1-hour rejection. Okay, I would have my stop just above the low of this structure, so just above here. And then I would look to target, as a first inflection point, to the low of the structure, we would have about 4%. I personally wouldn't be targeting this low. Yes, it's a sharp move, okay? And you might be thinking, well, you've said previously that that's where the volume is. Why wouldn't you be targeting there? The reason I wouldn't be targeting there is because when you have this much volume built or generated literally just above even a sharp move, it doesn't normally stop there. I can't remember the last time I saw this much volume built up. Price just taps an area and then retraces from there, unless it's like a reversal structure. If it was a reversal structure like that, that would be different, okay? But it's not a reversal structure. So therefore, that much volume, we broke out of that much volume to the downside. That, in almost every case that I've observed, that's not going to hold. This is not going to hold price. It's not going to stop there. Okay, so therefore, I would be targeting the next low, which just so happens to be a near miss to here, okay? So the start of all of this is there, and that's the near miss to it. I would target that because the near miss and the 90% area of a range is often where price could pull back. And also, if we just measured this, so I'm measuring this impulse. If we measure that, look where it lines up again. It lines up literally, if we get it exact, it lines up perfectly again. So although I do these things crudely, you can see that they mathematically line up because the market is leaving these psychological patterns repeat themselves. The volume, what the volume does after it's broken out of what the volume, where it tends to respond from, where it tends to near miss from. It's all a reflection of the psychological behavior of people. Okay, so that's why these patterns line up, why these measurements, even though drawn crudely, line up a lot of the time. But that's what I'm going to be looking for, folks. If this doesn't happen, I've got an alert set just below this, the high of this structure, because that's the only area that I'm interested in trading in. So that if that alert doesn't trigger, there's no need at all for me to check this trade. And if you could literally just do that, you will take less losses. So if you're someone who's losing a lot of money trading, if you literally just identify your areas of value, and if the market doesn't trigger those, you set alerts there. If the market doesn't trigger those alerts, you just leave the pair alone. You will lose a lot less money, okay? And if you're already profitable, you'll make a lot more money. But anyway, that's what I'm going to be looking for today, folks. If it shapes up, I place a trade, I'll bring you a trade recap on Monday. But for now, have a great day. Have a great rest of your day, a great weekend, and I'll see you again soon. Thanks for watching.